Good morning and welcome this morning to Trading Index Options under the great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. And I'm joined out there in the chat by my good friend Cameron May, 20-plus year veteran of the financial markets. And he is there to help answer your questions along the way. Speaking of all of you, thank you for joining us. Thanks for being here in either the live version, which those of you who are in the chat right now are, or in the recorded version, which we can't see you because it hasn't happened yet. So do me a favor, participate in the conversation. If you're here in the chat, add to the chat, ask a question, create a conversation, keep that community going. If you are in the recorded version, leave a comment in the comment section. We'll get back to that as quickly as we can. Usually within 24 hours, we respond to those questions and comments. So we're glad to have you here. The market is at a bit of stasis at the moment. We'll see what that looks like, and maybe starting to take off a little bit, but that remains to be seen. So we're going to talk about that. We're going to talk about our 14-day, 7-day cycle SPX idea. And I had an idea this morning, given the fact that volatility is very low, that means umbrellas are cheap. I'll explain what that means here in just a minute as we get started with a couple quick housekeeping items. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation or any kind of advice or recommendation, whether it's a particular symbol or a particular account type or anything else. None of that is a recommendation. Remember that equity and index options carry a high level of risk. They're not suitable for all investors. Make sure that you are aware of the characteristics and risks of standardized options before considering any option strategy. Make sure that you understand that concept before you consider any of these ideas. Remember also that trading options, especially multiple leg option strategies, generally is done in a margin account. It requires and will entail multiple transaction costs, so be aware of that. Also, remember that one of the risks in trading options is the assignment of a short option. We create an obligation when we sell an option. The index options that we're going to be talking about in this discussion today are by and large European-style options, which do not have that assignment risk. That's one of the benefits of trading index options. But American-style short options can be assigned at any time up to expiration, regardless of where they are in the money, at the money, out of the money. Now, the paper money platform that we're using in the Thinkorswim desktop software platform does not facilitate that early assignment of short options. Now, if we're trading European-style index options, we don't have to worry about it. But if you're trading American-style equity options, that is a possibility. You need to make sure that you're aware of some of those differences as you move from paper trading to live trading. Of course, remember that stops aren't a guarantee of the execution price of the order. And in fact, some cases in the stop limit order, those prices might get gapped around. So with all that in mind and in our backdrop, what I want to do is I want to flip over here to the Thinkorswim desktop software platform. We'll take a look at what's going on in the market and seem to see perhaps a little bit of upward movement here this morning. We've done a couple of things in the last little while. We've looked at not only this upward movement of the SPX. Last week when we were here, we were looking at the SPX kind of running into a little bit of a resistance level. We were right about here at this 59.88, 6,000 level, kind of running into that resistance. RSI now, though, seems to be accelerating. We're now at a new intermediate term high, not a new long-term high, but the RSI is at a slightly lower level. That would suggest that maybe there's a little bit more room to go. It's not overcooked, it's not overbought. At the same time, some traders might read this as a slight bearish divergence, which might be an indication of a pause or the possibility of a pause when that RSI high is a little bit lower versus price being at a higher high. That may be an indication that this is coasting uphill instead of being driven uphill. Now, I'll tell you what, Cameron May out there in the chat teaches a webcast on Fridays, advanced charting techniques. And one of the things that he does in that particular webcast is he breaks down technical indicators, including indicators like the RSI. So you have questions about an indicator like that and what some of those things mean, those divergences and other things, great place to go would be to that Advanced Options webcast on Friday to learn a little bit more about that. And by the way, if you're going to join us in Miami on Friday for the first market drive of 2025, I kind of like the ring of that. But we're going to be at the JW Marriott Turnberry this Friday, right? A couple of days from now. We're going to drop into Cameron's webcast. So if you are in Cameron's webcast, make sure you say hi. We're going to be bringing 600 or 700 additional viewers to the webcast for a few minutes. So it'll be a good opportunity for those viewers, those audience members in Miami to see what a webcast looks like and what the great information is that educators like Cameron provide. Now, taking a look at what's going on, I like what CES says. It kind of looks like head and shoulders forming, right? An inverted head and shoulders. And I would argue that we probably had that inverted head and shoulders maybe down here. We might have that inverted head and shoulders kind of breakout right here that we could perhaps hang our hat on. Well, we couldn't hang our hat if we're upside down, if it's an inverted head and shoulders, because our hat would fall off. Sorry, that's a bad joke. Anyway, starting to see this price move into the upside on the SPX. Taking a look at the NASDAQ, starting to see the same thing, right? A little bit of a gap to the upside, although we saw some downward movement. We're seeing in this most recent candle a bit of hanging man element to that candle. So gap up rally, but a little bit of sell-off early, now kind of coming back in a little bit. And we take a look at the Russell 2000, and we're now banging our head against that 200 period moving average, which this is the last of the big three indexes to break back above that 200 period moving average. It hasn't done it quite yet, but it is getting closer. Now, no guarantee that it will, but again, you're seeing the RSI pushing a little bit higher here. So we've got some bullishness abounding, right? Now, not huge bullishness. We're not blowing the doors off. At the same time, there's news about it, right? I mean, we have news coming out that theoretically, thank you, Cameron. Theoretically, the U.S.-China trade deal, at least a part of the trade deal is done. The rare earth metals deal portion is done. That may be lending itself to this bullishness. At the same time, we know how tenuous those deals have been. We know how tenuous that relationship has been, and that could create a reversal in price action in terms of these indexes. So the reason I bring that up is if we take a look at what's going on in volatility, and I'm going to look at my VIX grid for that, we can see the volatility still moving lower. We're down in the 16 handle, mid 16 handle, and moving a little bit lower. And we talked about last week, we talked about selling a call spread on the VIX index with the idea that it was going to continue to move to the downside. And that, in fact, played itself out. It was a successful trade. It was a short-term trade. I think we were at like a 3 DTE trade, 3 days to go until expiration. That ended up going out for about 85% of what the max theoretical gain was. And we talked about the idea of taking advantage of this kind of general push to the downside, this mean reversion of VIX, but the risk was a black swan event to the upside and creating that push through that vertical spread and taking that maximum theoretical loss. The maximum theoretical loss on that trade was relatively low, but high compared to how much we were getting. So I know a number of you have been asking the question, well, wait a second, all these trades have a low return for a high potential maximum theoretical risk. Yeah, but they're high probability trades, and that's kind of the thought process, right? So that's the way that we kind of view this. Not every trade is going to be a 10-bagger winner, right? And not every trade is going to be more than your potential risk in the trade. Sometimes, especially in indexes, when we're talking about, not big movement, and we're talking about hedging against adverse movement, for instance, sometimes those trades are going to be low return, higher risk, but also much higher probability, right? So that's kind of the thought process. So the next thing I wanted to look at here, though, is this relationship here. VIX is low. VVIX is starting to rise. Now, VVIX has been kind of tracking along. Now, VVIX is the volatility of the VIX, and that is essentially an indication of how willing index option participants are, i.e., lots of institutional investors, traders, how willing they are to buy protection instruments, i.e., VIX, or excuse me, SPX options. So when this VVIX is starting to rise, that's an indication that they're at least willing to buy them, even though they're low. So what we're maybe seeing here is a bit of buying of protection assets, meaning buying of SPX puts, for the sake of protection against a black swan event when those index options are relatively cheap. So we can kind of put that to work for us in this conversation. So we're going to talk about that as we get into this discussion, but I wanted to set the stage here for that scenario. Now, just because the VVIX is rising does not mean that the VIX will rise. If the VIX does rise, however, VVIX will generally rise. I don't know that I've seen many times when the VIX is rising, but the VVIX is falling. Oftentimes you'll see that simply because that's an increase in volatility, right? So let's take a look at a couple of things that we've got going on, first of all, and let's manage. Actually, you know what I want to do first? I wanted to look at one other thing. So I'm going to bring in here the single grid. This is my kind of playground, right? And I want to bring in an index, and I'll change my bottom indicator from implied volatility to RSI. Right. And again, Cameron, thanks for putting that playlist out there so that people can go and take a look at this indicator. But here's RSI. So what I wanted to look at, not Apple, but I wanted to look at XDS, which is the Swiss franc US dollar index. VVIX tends to be a little bit of a lagging indicator. So let me ask this question really quickly. Why would there be an index tracking something like the Swiss franc and the performance of the Swiss franc versus the US dollar? Why do you suppose? I'm just curious as to why you'd think that there might be an index that would track this movement. So this is the index of basically there are a lot of different ways to play this relationship. There's the futures contract, there's the currency pair, the Forex pair. There's this index, right? Why would we be interested in tracking the performance of the Swiss franc versus the US dollar? Because that's what this is. This is Swiss francs priced in US dollars. Any ideas? What do you think? Okay. Now, while you're thinking about that, I'm going to put a line on this chart. So what I'm going to do is I'm going to come over here to the flask icon at the top of the page. I'm going to go / I'm going to actually go, first of all, comparison. We're going to add a comparison, and the comparison line that I'm going to add to this chart is going to be / 10Y. Okay. Now, I'm using this not as a tradable instrument, not the futures contract as a tradable instrument, but I'm using this as a measure of 10-year interest rates, right? 10-year interest rates, something that the small caps are interested in, investors are interested in, mortgage owners are interested in. So here's the thought. Okay, so CSS, Swiss franc, much more stable than the euro, sure. Okay. Swiss francs are considered a world currency. Good. That's another absolutely correct answer. So let me ask the follow-up question to this. Have any of you heard or participated in the carry trade? Right? Yes, there you go. Okay, so Healthy says maybe they divest from US dollars, maybe Swiss francs. Where have our interest rates been? So this has been the line. That purple line has been the line of US interest rates, those 10-year rates. Interest rates have been relatively high, right? So interest rates right now about the 4.4 something level. right? So when US interest rates are high and the interest rates for currencies, stable currencies like the yen or like the Swissy, uh, are relatively low, investors can sell those currencies and buy our currencies and get a higher rate of return. That's that carry trade, right? So that's a complex instrument, right? And for a lot of traders, that gets into spot currency, that gets into forex and calculating those interest rates. But there's a more direct relationship here. When U.S. interest rates fall, generally the Swiss franc rises relative to the U.S. dollar. When U.S. interest rates rise, generally the Swissy falls. So what's happening with U.S. interest rates right now? They're kind of pulling back a little bit. What's happening with the Swiss franc index? It's rising. You see that opposite or inverse correlation. So if our rates are falling, that means that investors, global investors, are piling into the Swiss franc to take advantage of its safe haven. They're not selling the Swiss franc. They're unwinding that carry trade. Okay, I know a long, complex idea, but the idea is this. When our rates fall, the Swissy goes up. So we're going to play this relationship in terms of taking advantage of this scenario. U.S. interest rates falling. Now, here's the other thing, though, to think about. The risk in this type of trade is to Sia's point and to Ricebird's point and to Healthy and Giroux's point, the Swiss franc is oftentimes the safe haven. So something happens to our currency, something happens to our economy, generally they pile into the Swiss franc because it is a more stable currency, perceived to be a more stable currency. So this could see strong upside movement if if something starts to happen to the trade deal, something like that, right? Okay. So my thought is go long the Swiss franc, but do it with an index. So, by the way, speaking of going long something, there's a feedback survey out there in the chat. And I'll tell you what, going long means we're buying something. So what I'd love to have you go long on is filling out this feedback survey, helping us out to make these webcasts better. All right? Yes, Swiss franc becoming expensive, not a good time to travel to Switzerland. But earnings in the country are better then. Yeah, absolutely. So we're going to go long the Swiss franc, but we're going to do it. And that by relationship means that we're kind of going against the carry trade. So we're going to go long the Swiss franc index by creating either a long call option or a short put option, or excuse me, a short put spread. And because we don't have that assignment risk, we have that potential to do that. So we're going to do this. We've got our XDS. There's our comparison line. XDS seems to be rising. And we're going to go to the trade tab. Now, here's one of the things to think about. XDS has options. There aren't a lot of choices here. So, hey, thank you, Carol. I appreciate that. So we're going to look at either going long the Swiss franc in a short term or long the Swiss franc in a longer term perspective. Now, we could do this as a long calendar spread, which might be something that we could do in this scenario as well. And in fact, or excuse me, not a long calendar, but a long diagonal. I'm going to look at simply going long the single here. So if we were to go down here to the options, now the problem is sometimes these bid-ask spreads can get a little bit wide, right? They can get a little bit wide here. So what I'm going to do is I'm going to look at either going long a call option, and I've got a relatively narrow bid-ask spread just in the money here at the 121 strike. Okay, and that 121 strike is kind of rolling back and forth to the at the money strike. We can see that these prices are moving back. The challenge, if we were going to create a short put vertical spread or a short put, is there's just not a lot of premium over here on the out of the money side in those short options for this expiration. If we were to go out to the next expiration, there's still not a lot of premium to be had, but the bid-ask spreads are a little bit tighter here. They're about 20 cents wide. on that side. So, but we're in that trade for a longer period of time. So you got to calculate that opportunity cost in that particular case. So what I'm going to do is I'm going to look at kind of balancing. So theta is pretty small either way. I'm going to actually look at maybe creating a long call calendar spread, not calendar, scratch that again. Long call diagonal spread. We really don't have a roll opportunity here, but it's going to buy down the cost of a long in the money call option here on the Swiss franc, which gives us the opportunity to trade that longer term upward rise, but it sells off some premium that helps us to maybe mitigate the cost a little bit, right? And as long as this doesn't make a big move to the upside, then we can look at that potential as just kind of a one and done on the diagonal and keep the long call option. So I'm going to go to the 120 strike, and I've got a fairly narrow bid-ask spread there. I might even go to the 110 or the 119 strike. And you notice that I've got even a little bit more narrow. Well, maybe right here. We'll go to the 120 just to make it nice. So I'm going to go to the 120 strike, and we're going to buy that 120 strike. That's that long call. And if you remember, a diagonal spread is essentially buying an option at or in the money and then selling an option at a different expiration date at or out of the money. So in this case, we're going to buy this one, and then I'm going to come back to this shorter dated expiration, and I'm going to look at selling, in this case, right at that 122 strike. And the reason for that 122 strike is, remember, we don't have assignment risk here, right? So if this kind of muddles along, we're not worried about this being assigned for the next 9 days. So we'll see what we can get out of this, and then we might be left with that long call option. So if we click on confirm and send, actually, before I do that, I'm going to right click and I'm going to analyze this trade, and you can kind of see what that looks like here, right? So here's our diagonal spread. If the price goes down, that works against us because it's going to eat away at our maximum loss, but our maximum loss is going to be relatively small here. It's what we put into this trade. If it goes up a lot, that kind of hurts us because it kind of compresses against that zero line. We can increase that by increasing the strike of where we sell that short leg. So we can sell the 123 strike, and we open up the lock where it's going to be a higher debit. We're not going to get as much premium, but we're kind of locking in that potential range of movement to the upside. So I kind of like that a little bit better. Buying that long option for 320, 65 days out, selling the 123 strike for 9 days out, and that buys down the cost of our long option to about $3.20 per share. So our max theoretical risk in this trade, if we click on confirm and send, is what we put into the trade. So we're taking advantage of that potential upward movement, and we're giving ourselves the opportunity to have not only that little kicker if it ends up at 123 at expiration, but if it goes up a lot, if we get some kind of move to the upside on the Swiss franc, then we've got that range to move. The downside is our loss goes to $3.20 from $2.80. So not a bigger loss, not significantly a bigger loss, but it gives you that opportunity, right? Now, you could put a put diagonal and kind of create an iron condor. It's gonna cost more, right? But in this case, I'm gonna simply go because this is a relatively low cost entry trade, and it's a defined risk trade with a defined potential maximum gain, right? So once again, it's kind of playing those probabilities, not a big return on risk, but high probability trade, right? And we don't have early assignment risk. So we're going to go ahead and we're going to fire this order off. I'm going to adjust this order to the 123 strike again. We're going to open up that lock, and we're going to go ahead and click on confirm and send, and we're going to put this in our index options group. And we're going to fire that order off, and we'll see if that gets filled. Okay. Now, if you want to learn more about this, and I know that was a little more complex example, and I get that. I'm going to ask Cameron to go and grab one of the advanced options webcasts that talks about diagonal spreads specifically, right? And see, exactly. That's the beauty of that lack of assignment risk. That's the benefit, is that we don't have to worry about being assigned, even though we're selling right at the money position, or just about at the money position. Okay, cool. So there's that trade. And we might have to bump that a little bit, work it to get it to fill. Let's see if we can come in here, right click, cancel, replace. We'll kind of open up that lock a little bit here. We'll give it a little bit more. We'll give it up to 350 to be able to enter that trade, $3.50. We'll put it back in our index group. And we'll click on send and fire that off, and we'll see if that fills. That may not fill because of those wider bid-ask spreads. That's going to be potentially a challenge. That's one of the risks here. But you get the concept. And the important thing is not that this trade specifically, this specific example is not the point. The concept is the point of, there it goes. Now it filled for us. We got it for $3.23. So the concept is taking advantage of global circumstances, using index options and using the benefits of the index options to help us out, right? Okay. All right, so let's do this. Let's go to the charts again, and we're going to go to our index grid, that one that we've been using. There it is right there. Index options grid, and we're going to go to the SPX. So this is back now down to our, thank you, Cameron. Perfect. Exactly. Thank you for grabbing that one. I appreciate that. We're going to come back over here to our monitor tab, and we're going to take a look at our 14.7 weekly index options strategy. So the concept for this, for those of you who are brand new, we sell a vertical spread on the SPX at 14 days to go until expiration, and then we buy it back and we take that off at 7 days to go until expiration, come what may. Meaning, win or lose, we're going to take that trade off at 7, and we're going to roll to, or we're going to move to another 14-day expiration. So last Wednesday, when we were here, we sold the 57.80, 57.60 short put spread, expecting bullish movement. We sold it for $2.10. It's now trading for for 32 cents. So closing this trade down, we get about, in this case, about 80% of our maximum theoretical gain in the trade. We're not putting stops on this. We're not putting a profit target. We're simply taking it off at 7 days, come what may, to illustrate what can happen. Fairly large maximum theoretical loss if this goes against us. And we've taken a couple of those in transition when the market has moved significantly. We've taken a couple of those big losses. So what we're going to do is, first of all, we're going to close this one down. I'm going to create a closing order. We're going to buy back this vertical spread, and we'll buy it back for 35 cents. And we're going to go ahead and close this down. Again, making sure that our order says to close. We're closing it down. We're going to read through any alerts that exist there. Click on send and fire that order off. And we close that down, and it is done. Now, what we're going to do is we're going to go to our trade tab here, and we're going to determine where our 14 days to go until expiration date is. That's the 25th of June. That's right here, 25th of June. And we're going to look at a couple of things. Okay, we're going to go back to our charts. And on this chart, what we have on the right-hand side is our probability of expiring cone. And what we have on the left-hand side is our 200-period moving average. So the consideration here is, as long as the market is above the 200-period moving average, we're selling put spreads. As long as the market is below the 200-period moving average, we're selling call spreads. So this whole time right here, we were selling call spreads. Now that we're above the 200 moving average, we are selling put spreads, okay? We are selling put spreads because they have a bullish bias. Market's above the 200-period moving average. We have a bullish bias. We're going to sell put spreads on this. So now what we're going to do is we're going to grab a tool here in our drawing set, which is our time level. And it's basically just putting a vertical line at a particular time on the chart. So we know that our 14-day expiration is going to be 6:25. So I'm going to just put that time hack on the chart at 6:25. And I'm going to say, okay, where are we going to sell the put spread, at what level are we going to sell that put spread to be at 1 standard deviation, right? 1 standard deviation of movement. That's what this curve represents. So that's going to be right about the 58.60. I'm going to call it probably 58.65. And we'll just put that line right there. That's our kind of horizontal hack. And so that intersection, you can see what's been going on. These are the last 1, 2, 3, 4 trades. We've seen that volatility has increased and then decreased. And what's happening is, even though the index is moving higher, this is moving a little bit closer as volatility decreases. Because when volatility decreases, the range of that 1 standard deviation curve decreases as well. This curve becomes narrower when volatility decreases. It becomes much wider when volatility increases. So we're going to look at selling at about the 58.65 level. So we're going to go to the trade tab, and we're going to go to our expiration date, the June 25 expiration. I've got 100 strikes here, and we said, all right, 58.65. 58.65 is going to be about the 15 delta. That's okay. So we're going to do this, and we're going to create a 10 wide vertical spread. We're going to sell we've gone 20 wide, and we could go 20 wide here. In fact, let's look at that. Let's go 20 wide potentially, because that's kind of consistent with what we've been doing. 58.65, we're going to sell that put, and then we're going to buy the 58.45 so that we're 20 wide, and we're going to bring the $1.70. And you notice how much less we're bringing in, right? You notice how much less we're bringing in here than we did even last week? Last week we brought in $2.10. Now we're bringing in $1.75, maybe $1.80. Why do you suppose that is? Why are we bringing in less for selling these put spreads a week later than where we were a week ago? What do you suppose is the reason? I already talked a little bit about it, right? So let's see if you're paying attention. Speaking of paying attention, there's that feedback survey out there in the chat. Also, good opportunity right now to ask you to click on the subscribe button down at the bottom of the page, and also click on like if you like this class. Yeah, with low VIX, premiums will be less, period. End of story. Yeah, Wiley, see, yeah, you guys all have it. Yeah, volatility dropped. Volatility contracted, less implied volatility, lower VIX. Yeah, that's why we're bringing in less premium. That's okay. But what that means is, if we're bringing in less premium and we click on confirm and send, and we take a look at our risk versus our return in this trade, this is okay. So XDS is European style, but the return on this trade is lower against our max theoretical loss. But we're at the 15-cent delta. So think about probabilities, right? So that's an 85% probability that this option is going to be out of the money at expiration. So high probability trade. Now you could, Ed, do 10 wide 2 contracts. And that's a possibility as well. So for simplicity's sake, and totally understand that, but for simplicity's sake, I'm going to keep this 20 wide 1 contract just to keep the integrity of the trade. But by all means, and you think about that from that standpoint, bringing in maybe a little bit more premium, because you're not, well, but you're spending a little bit more to buy the 10 wide spread. You're spending a little bit more in terms of premium to provide the risk definition on that trade. We'll go ahead and we'll place this order. We're going to put this in our vertical or our index options weekly. We're going to go ahead and click on send, and we'll fire this order off, and we'll see if this gets filled. It might have, because I might have talked through it a little bit. We'll right click. Nope, we got it for $1.90. That's okay, cool. I'm glad we got a little bit more for it, right? I'm glad that we got $1.90 out of it. And so here it is right now, $1.90. It's already started to work in our favor a little bit. Now, one other trade that I wanted to look at in this context is this one. And this is one that we've been talking about for a little while. Here's our XDS trade, which is already starting to work in our favor just a little bit here, that long diagonal. But what we've got also, if you remember, we had this long put on the Russell 2000 that we bought quite some time ago. It's now down to 19 days to go until expiration. We paid $33 for it, but we did that as part of a spread. So that was what we paid for that leg. We've collected some premium against it a couple of different times. It's now trading for $5.80. So it's a sunk cost. We could close this down and we'd get the $5.80 and we'd kind of recoup some of that cost. The problem is this is now far out of the money. So the rate of time decay, if we go to let's go to the trade tab for the Russell 2000, right? This is a 2030 put. So I'm going to go to the Russell 2000, RUT. This is a 2030 strike put. And let's kind of scroll down here. I've got 100 strikes. You can see where it is. It's at about the 10-cent delta, right? It's like way out of the money. So its rate of theta is not huge. In fact, as we start to look at some of these other expirations, here we are at 19 days. If we come down to 14 days, we can see that, in fact, its rate of theta at the 2030 strike really has slowed down pretty significantly. And that's kind of the basis of that 14.7 trade that we just looked at, is that an out-of-the-money option time decay curve does this as we get towards expiration. So this option has already seen really the majority of the time decay that it has, it's going to incur. And in fact, what's going to happen is this theta is going to really slow down as we get closer to expiration. We have fewer times that we could do this, but we still have something that we could kind of eke out of this particular trade from that perspective in terms of playing the benefit of having this long option that's way out of the money that we've already paid for. And so rather than trying to recoup that $5.80 all at once, which is going to be all we're going to get out of it, what I'm going to look at doing is I'm going to come down here to 1 day to go until expiration. And I'm going to look at selling an option to bring in some premium. Now, look, implied volatility on this expiration is 23%. That has an implied move or an expected move of about $22. So the market, the Russell 2000, is currently sitting at 2168. That would mean that that expected move could put the Russell down. If we saw that expectation in the next day, it could go up or down by $20 or $22. So that would mean that we would see on the downside about a 2146 level, 2146. So 2146. So we know that we're short long the 2030, right? This is the one that we're long in that 19 days to go until expiration. So what if we were to sell the 2045? Oh, we just don't have enough premium there. There's just not enough premium to be had. Oh, but wait a second. I forgot the digit there, 21. Oh, I was counting wrong. There's $3.45 or $3.20 to be had if we were to sell this. Now, Russell is European style as well, so we don't have assignment risk. So the thought is selling this 2145 and then either buying it back close to expiration for less than we were paid for it to begin with, or letting it expire and then selling another one. Because if it expires worthless, it's worthless, and we get to keep that premium, right? And that's served to buy down or offset some of the costs that we paid for this long option. But it becomes not the risky short put option because if we were to just create the trade here as a short put and we didn't own that long option to begin with, look at what our risk is in the trade, right? Maximum theoretical loss, 214,200. But because we know that we have, all the index options that we'll talk about in this webcast are European style. It's a good observation. So what we're doing is we're defining our risk. This is the index going all the way to zero. The likelihood of that happening fairly low, but at the same time, not impossible. But we've defined our risk as the difference between, let's do this. We've defined our risk as the difference between 2145 minus 2030 115 points, right? So that means that we're not going to see $245,000 of risk. We're going to see significantly less because we've got that long option that we could choose to exercise to mitigate that risk, right? So that becomes the reason for doing this trade instead of just doing this as a short put or a short put. So we're going to confirm and send this order. We're going to read through this order, make sure that that's what we want to occur, make sure that this is to open, and we're going to put this in our index options, and we're going to go ahead and we're going to click on send, and we're going to fire this order off, and we filled for $3.65. And what that means is now we go to the monitor tab. Here's our long put option. Okay. If we were to just sell back that long put option right now, we already spent $33.75 for it. We brought in a little bit of premium, brought in a little bit of premium, brought in a little bit of premium. If we were to sell it right now, we're going to get $5.80 for it. But why not hold on to it? Because it's not losing that much value because of time decay. And bring in $3.65 of premium to offset more of that. So we're getting more than half of what we would get if we were to just sell the option to begin with. So we're just turning this once again into a long put diagonal spread. And that's okay. A long put diagonal spread in this particular case is okay, but this is kind of creating that perspective of saying, wait a second, let's see if we can harvest some premium against the risk definition of that long put that we've already paid for. So we're going to do that. That's 1 day to go until expiration. We'll see how it did next week. And what about Theta? Well, Theta's working more significantly on this one, the 2145, if we go back to the trade tab. So look at the Theta that we're collecting on this one, essentially. $3.44. So we know that this has 2 days to go to exist, right? Today and tomorrow. So that means we know that at tomorrow's expiration, at the end of the day, at tomorrow's end of the day, this option is going to expire and all of that time decay is going to go away, right? Wow. Cool. So we're taking advantage of high rate of Theta against the low rate of Theta. So essentially we're creating another type of carry trade, right? That's what a diagonal spread is. That's what a vertical spread is. That's what a calendar spread is a type of carry trade, trading the disparity between one instrument and another instrument. We've looked at interest rates, we've looked at currencies, we've looked at volatility disparities, we've looked at Theta disparities, a lot of different ways that we can kind of approach this idea of arbitraging that relationship. So hopefully that was a helpful strategy. So what we've done today, we'll go back to the monitor tab here really quickly and kind of walk through this. We traded that currency spread, the Swiss franc US dollar index, and we traded it in an upward direction. We created a long call diagonal. We bought an option 65 days to go until expiration, sold one 9 days to go until expiration. Then we bought and managed our vertical spread 14.7. We bought back in this one that we bought in for 34 cents, and we sold another one for $1.90. And we've continued to keep this long put option going by selling a put option against it, creating, again, a long put diagonal spread. So that is, I think, a kind of a full circle here in this context. Speaking of full circle, help us out. Fill out that survey that's out there in the chat. Let us know what you think. Help us to make these sessions better. We appreciate you being here. Again, if you like this webcast, click on the like button. Click on subscribe so that you can stay in contact with this discussion. If you want to learn a little bit more, great place to do that is right here at the Trader Talks webcast page. You can click on this little search box right here and search for whatever topic you want to learn. Guys, thank you very much. I appreciate you being here, and we will see you again very soon. Take care, everybody. Thanks, Cameron, and thanks to our great production staff for helping out. We'll see you in Miami on Friday, and then I'll be back here in this webcast on Wednesday. Take care, everybody. Bye-bye.